There's a number of factors, right, that could lead to explain the gold trade in recent years. Central banks diversifying reserves away from the dollar, investors seeking alternatives to bonds. But then in the last couple of weeks, it's really tricky also to understand what gold represents.
Yeah, look, I think we've had a shock clearly here with the conflict beginning, and I think it's not unusual to see gold initially pull back when we do get these shocks. We saw that in COVID, we saw that at the beginning of Russia-Ukraine, we saw this in Liberation Day, and this is where gold's liquidity works against it. It is your most liquid asset. It is what you sell to free up cash, whether that's to pay margin calls or reallocate elsewhere. It does also look like we've had a bit of technical selling. We've definitely found support at key moving averages, for example. We bounced off the 200 days, so that suggests that there's perhaps some technicals behind this. But I guess the difference for this shock versus maybe, say, Liberation Day is that what it means for inflation and central bank actions around interest rates. And I think, look, here we have seen the pricing on the Fed change from expecting rate cuts to rate hikes. We know gold is sensitive to that. We've had the dollar creeping higher as well. And if we remember last year, we did have arguably safe haven demand for gold, but with a weakening dollar, and that's highly unusual. So we're getting kind of the reversal of that as well.
So it doesn't fundamentally change your view on what gold could become?
I think, look, gold should still be that real asset. We should still be thinking about, I think that shift in investor demand for real assets that took place last year, as particularly with concerns around fiat currency debasement. I think that narrative is still there, but I guess at the moment we do have to deal with some of the changes. And one thing I would say is, if you say your two big buckets of gold holders or gold buyers have been central banks and exchange-traded funds, look, we can come on to Turkey and the sale, but the exchange-traded funds they can flip from selling to buying and back again. In 2024, they bought zero. In 2025, they nearly bought as much as the central banks. And so they are quite sensitive to what the Fed is doing. And I'd say if the narrative does start to become that we are at risk of a hike or maybe a longer pause, you might see that liquidation coming through.
I mean, could you see more central bank selling of gold?
Yeah, look, it's always tricky to say. I mean, Turkey, obviously, it's a large amount, 60 tons of gold. Yeah. Central banks collectively bought about 860 last year. I think already we were seeing a slowing pace of buying, so then it doesn't take much selling to start to weigh down. There were some discussions, I think, in Poland around as well, a more active management of their gold reserves. I mean, Poland was the largest buyer last year, so if they started to sell, that would obviously have an impact as well. I don't think anyone else has said it as of this point, but definitely I would expect a slower pace of aggregate buying.
And Amy, I mean, I guess apart from, we focus so much on oil and gold as an asset, is there anything else in that space that you worry or that hasn't behaved the way that we thought it would in the mining world?
Yeah, so look, I would say base metals are having a sort of a push and pull factor as well, and maybe aluminium is the one that stands out here. So aluminium is the one where everyone's first attention was drawn to what could be disrupted by the Middle East. So the region is about 9% of aluminium production. A lot of that leaves as exports, and at the moment, obviously, that anything stuck behind the Strait of Hormuz is not really making its way out. The region is also very dependent on imports of alumina and bauxite. So again, are we running close to critical levels on those raw materials? So aluminium initially had a lot of support both to the price and also the regional premiums. That's now come off a little bit because we're starting to worry about growth. And so I think that's where the base metals have this push and pull. At the moment, it feels like aluminium is still outperforming the rest of the complex, which I think makes sense. But we'll have to see where these growth worries go.
I mean, I get it, because we're starting to think about possible demand destruction, right? If everything goes, what data points do you look at first to have a sense of, is it some of the data coming from China or elsewhere, to understand where some of these base metals go?
Yeah, look, I think China's the place where we typically get the most data. I would say actually on copper, that's been looking fairly encouraging with this pullback. So we've seen copper inventories in China pulling back faster than normal. We've seen physical premiums in China jumping. So it does actually suggest maybe that they've been buying the dip a bit here. I guess elsewhere is maybe where we'd see more of a slowdown. But what I would say is this is not 2022, which is where we had a very big demand shock. But part of that was exacerbated by the supply chain was very well stocked. We'd had the COVID supply chain shock. Everyone had started to hold a little bit more, that just in time to just in case. And then as interest rates went up, the cost of financing that went up and everyone destocked. I would not say we're there. I think if anything, this could actually prompt that restocking cycle when things have settled, because suddenly everyone's realized how vulnerable their supply chains can be.
I mean, how fast could that happen? Is it impossible to say at the moment?
I think it's difficult to say, and again, it's going to depend on interest rates, because we have to think about the cost of financing. But I think, particularly as we go into 2027, I would expect, you're going to have to start hearing about stockpiling, and even at the government level, not just at the country level, company level.